Welcome to another wonderful, actually a beautiful day here in Southern California. We're in Coachella Valley, but anywhere in California, it looks like the weather is really nice, and we have a great show. Before we get started, I wanted you to write down, take out a piece of paper and a pencil, write down overcoming adversity. And then when you get in there, if you happen to Google it, you'll probably see this guy's picture. His name is Alvarez. He can overcome any adversity, especially when it comes to, hey, I need a mortgage. I want to refinance my house. Should I do whatever kind of funding? He is your guy. Let's bring him on. Art Alvarez, welcome.
Hi, Jeff. How are you?
Hey, I'm great now that I can hear you. We had a little technical issue. It's been one of those days with the computers. We love technology, except when it doesn't work, right, Art?
Right. Yeah. And sometimes you just have to plug it in.
That's it. Hey, so we got a great show. We got kind of a light week this week. I can't wait to hear what's going on. But before I turn it over to you, I just want to remind everybody that this is a live show. Please make sure to put any comments or questions in the comment section. I'll be in the back end. I'll feed it over to Art. He loves answering your questions while we're here live on the show. He goes over everything you need to know to make good informed decisions. And make sure you stay around for a special section that's called Buy Downs or the Bomb. That's my favorite. It's a money saving opportunity, and it allows you to make a decision starting today. With that, Art, I'll turn it over to you. Have a great show.
All right. Thank you, Jeff. Thank you, everyone, for watching and listening to the Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. And if you're a regular on the program, you know we like to start off by giving you an update on mortgage rates and the bond market and so forth. And it's been a pretty good week, actually. In fact, it really kind of started at the end of last week. The good news is when Jeff brings up the rate grid here, you're going to see that rates are hanging in there despite the various news stories and online stories and headlines about mortgage rates being in the sevens. We're not in the sevens, we're in the sixes, which is commonly the case, that we tend to be a little bit below what the media is suggesting is the conforming interest rate levels. So you can see pretty much every product offering we have on this rate grid is under 7%. So that's good news. Underlying these rates is what's been going on the last week or so in the financial markets, and the 10-year bond yield. As I've mentioned many times, the 10-year bond yield is your best barometer for mortgage rates. And there it is. Jeff just pulled it up. The 5-year chart's kind of interesting. You all remember end of last week, the 10-year bond yield got pretty elevated. In fact, it got upwards of 4.6 and above. But at the end of last week, we had a nice little improvement because the job numbers were a little bit weak. We had the new jobs for the previous month was reported last Friday, as well as the unemployment rate, which ticked up from 3.8 to 3.9, and then new job creation that was reported on last Friday was not as strong as expected. And so that improvement continued going into the early part of this week down to, you can see there on Tuesday dipping down to getting close to 440, which is really good. But then you can see that the yield kind of climbed back up a little bit up until this afternoon, when it's again dropping down, getting a little bit closer to 440. Now, in terms of what's going on here, data points and so forth that have been released this week, extremely light. I mean, the economic report calendar for this week has been very, very light. Very few data points released at all the entire week. And so in terms of what is going on this week as a result, as you can see here on our bullet point of things to talk about, Fed speak. That's really kind of dominated the calendar this week. Not so much economic reports, but Fed speak. 9 different members of the Federal Reserve were scheduled to speak throughout this week at different conferences or interviews, what have you. And of course, with those, as they come out and they get publicized, there's difference of opinion among the Fed participants as to where we go from here with rates. Some are arguing that no rate cuts are imminent, and we could even see a rate increase this year. Other members of the Fed I saw indicating that where they've raised rates to date is sufficient, and that will do what's necessary to get us in line with the Fed target for inflation. And so that particular member didn't see any need for any increases. So there's a mixed bag there in terms of the members of the Fed. As with anything, you can expect that they're not all going to agree. So in that regard, in terms of hearing 9 different Fed members give their speeches and their talks, it's hard to kind of garner a conclusion about where we go from here. Midweek, I will point out to you, when you saw that chart, Wednesday and Thursday, the bond yield started to inch back up after Tuesday. Part of the reason for that is a little bit more technical. It was Treasury bond sales on May 8th and May 9th. We had scheduled Treasury auctions, including 10-year Treasury bonds being auctioned off. And oftentimes what happens when there is substantial Treasury auction scheduled on any particular week, to get those Treasury bonds sold, you can sometimes see what I call a yield bump. And I think that's really part of what happened as we got into midweek, Wednesday morning and this morning with these Treasury auctions that did cause a little bit of a bump in that yield when we were getting down in the low 440s, and we got back up to around 450 plus by Wednesday afternoon and even this morning. But those auctions are over now, and it's probably not a coincidence that as we got into later today, that bond yield's now trickling back down, under 450, under 445. In fact, at the latest that I just looked at, so that's good. And in terms of economic data reports this week, like I said, very light calendar. However, today we did have initial claims for unemployment. And that number is interesting. And it's another sign that maybe the labor market is softening up a little bit. And that's a key barometer to track where these mortgage rates and bond yields are going to go. Initial claims reported today, 231,000 claims for unemployment benefits. That was pretty good amount above the forecast. It was forecast for 214,000. The previous week, it was 209,000. So 209 to 231,000 claims for unemployment benefit. That's a pretty good jump. That's also part of the reason why the bond yield today, the 10-year bond, got back off of that 450. The combination of the Treasury auctions being completed and another data point suggesting that maybe the labor market's starting to soften up a little bit. And with all that going on, and despite we're seeing some improvement this week, which we can be happy for, all of the main participants in the mortgage industry have revised their interest rate forecast for 2024, for the end of 2024, as to where we're going to be at. So you can see the list there of some major participants. Fannie Mae, who previously had predicted or forecast that a conforming 30-year fixed rate loan would be as low as 590 by the end of the year, they've revised that. Now they're saying it's going to be 640 by the end of the year. MBA, that's the Mortgage Bankers Association, they previously had predicted by the end of this year 6.10 for conforming loans. Now they're saying 6.40. NAR, the National Association of Realtors, they had predicted or forecast 6.3 by the end of this year. Now they've backed off of that. They're hoping for 6.5. And then finally, Wells Fargo, major bank, their forecast earlier this year was that we would hit 6.05 by the end of the year. Now they've really backed off and are now only predicting or forecasting we'll get to 6.5. So these revisions by these major players have averaged about 1/4 to 1/2%. Now they think higher than what they thought early this year. So again, that kind of underscores what we've been saying and what, frankly, the Fed's been saying, most mortgage market participants, that in terms of mortgage rates, you can expect on those rates, they're going to be higher for longer. But again, I think that overall, we've had a good week, and maybe this is going to be somewhat encouraging going forward. I tend to be a little bit more optimistic. I can see us getting into the lower sixes by the end of the year. And who knows, it'd be really great if we get under 6 and get into the 5s. But that might be a little too much to wish for still this early in the year. So we'll see how that plays out. Next, I wanted to cover something that I think could really be big news and a big benefit in the mortgage industry. And it's something fairly unusual, something that I certainly didn't anticipate coming in all my years of doing this. And it has to do with one of the federal mortgage agencies, Freddie Mac. which is, of course, the Federal Home Loan Bank. And the Freddie Mac recently announced that they're going to be getting in the equity loan business. And the way I came across this was this news article from Fortune magazine, or Fortune Digital, I guess I should call it now. And the headline had mentioned that there could be $3 trillion injected into the U.S. economy without any federal spending by tweaking a particular corner of the mortgage market. And this was quoting a woman who is known as the Oracle of Wall Street. And it turns out what this lady was saying, her name's Whitney, that's her last name. She has proposed or is suggesting that $3 trillion could be injected into the economy through mortgage market reform, and without, that's what SANS means, without any federal spending. Well, what's the suggestion? Well, there's a proposal underway for a pilot program with Freddie Mac to enter the home loan equity market, or the home equity loan market, I should say. And of course, her suggestion is if that gets approved, that could be a $1 trillion boost into the economy by summer, $2 trillion by autumn. Well, why would that be? Well, the idea is that by having a major player in the industry, Freddie Mac, who, of course, they've been in existence for decades now. And what do? They buy conforming first mortgages from lenders. And then, of course, that ability, that process of buying loans from lenders allows for more liquidity in the U.S. mortgage market. In other words, lenders make loans, they sell them to Freddie Mac, again, first mortgages. And then after they sell them to Freddie Mac, they're, of course, going to get the proceeds, and then they can lend some more. So it creates a lot of liquidity in the U.S. first mortgage market. Well, the idea is with Freddie Mac, if they get involved with equity lending, then we could see the same kind of increase in liquidity, and that could be very beneficial to both homeowners as well as to the economy. Now, there is some concern that, well, let me back up a minute. One of the things that this addresses is that, and I've talked about this a fair amount in the last, several months, home equity lending has increased vis-a-vis or relative to first mortgage volume, particularly on the refinance side. First mortgage refinancing is not anywhere near what it was, during the pandemic years. It's dropped off pretty dramatically, frankly. And of course, equity lending, because there's so many homeowners with very low first rate mortgages, we keep talking about a whole bunch of equity. Equity lending has, seen a spurt in volume because of that. However, you'd be interested to know that even with that increase in equity lending, given our higher rates of the last couple of years and the high amount of equity that most homeowners have, home equity lending as a segment of the industry is really only reached half the level it was before the crash of '08. That kind of makes some sense to me, because back then, of course, this is part of the reason that was attributed to why we had the crash of '08, is there was lots of refinancing going on, lots of equity loans being taken out. In fact, it was routine back in early 2000s, 2004, 5, 6. We'd originate a purchase money first mortgage. And if it involved a transaction with a large down payment, we would oftentimes offer to the buyer, the borrower buying that home, to allow us to arrange an equity line of credit, a HELOC, simultaneous to their purchase loan, just so they could have it secured by the home to use, later on a rainy day. We used to do that all the time. And back then you could get these HELOCs arranged without forcing the borrower to take a initial draw at closing. Of course, that option is gone these days. So that was done quite a bit. Homeowners, frankly, were using their home as an ATM machine back before the '08, Great Recession. So part of the reason for this is to try to, create some more activity in the equity loan market, because it just hasn't come back to where it was back in after the '08 Great Recession. Now, there's some concern that this proposal, by injecting so much more money into the economy through pulling more equity out of homes, could kind of create more concerns about getting inflation under control. In other words, all this additional money, if it happens, could create some more inflationary pressures. But on the other hand, expanding home equity loan access without having to take on any federal debt, I think could be a pretty good way to kind of mitigate or minimize the impact, the inflationary potential impact by this proposal, gaining approval and moving forward. And that's something to keep in mind, is that this does require regulatory approval. It is a pilot program, so it does have to get approved before Freddie Mac can really get going on this. And from that perspective, I would say that could be a reason why these predictions, $1 trillion boost by summer, $2 trillion boost by autumn, that could be a little bit optimistic, only, given you have to, let the regulatory process play out. Freddie Mac's got to get approval to do it. It is a pilot program. They're not going to just make this available to all lenders in the country. They're going to start small and basically kind of build on the idea and build a viable program. But the point is, this could be a really good win-win for the government, for Wall Street, consumers, because it addresses economic needs effectively. It allows the consumers another way to tap into their equity, in particular when they have a very low first-rate mortgage, because that cash-out refi is really off the table if you have a 2 or 3% mortgage. So this is a way to give you more ways to access your equity without touching that 2 or 3% mortgage. And because of getting a quasi-federal agency involved in their ability to securitize these loans, and their ability to probably bring in or provide equity lending access to more originators across the country, that's going to have benefits like most importantly, probably lowering the rate on equity loans, which would really be a very good thing to see happen. So I think this is really, really potentially good news. I'll keep you posted on this. If it does get approved, you heard it here first. You might start seeing some really good improvements in both equity loan offerings in terms of product type, as well as the interest rates that are going to be made available for equity loans, given Freddie Mac's hopefully approved participation in this segment of the industry. So I thought it was overall very good news. I'm looking forward to see this getting in place. And with that, as Jeff mentioned earlier, I want to go ahead and give you this week's temporary buy down example. We're calling it Buy Downs Are the Bomb. And again, I do have another temporary buy down example from MortgageWorks. By the way, when I did this last week, I mentioned to you a property here in my local market in Coachella Valley in Palm Desert, two brothers looking at buying a home. And they had first approached me about making a low price offer. I suggested that they considered not doing that and instead making an offer using a 3-2-1 buy down. We're at the final stages. They did do what I suggested. They're pretty much down to the last couple of issues in order to get their offer accepted. So it looks like my latest example of this is going to work for that particular buyer or those buyers. So I wanted to give you another example. Now, this one, I decided to go with a property in the Orange County market, up over the hill. I actually grew up in Orange County. I was born in Glendale, but grew up in North Orange County. In fact, I grew up in Placentia. So I thought, it might be neat to find a listing in that city where I grew up and give you another example of how a temporary buy down could be the perfect strategy to use to acquire this property. So here you go. It's a single family home, again, in Placentia, California, 3-bedroom, 2-bath, 1,560 square feet, older home built in 1963. It's listed for $999,000, which is kind of unbelievable to consider when I grew up there and thinking about what houses cost way back then when I was a kid. It's been on the market for 27 days, actually probably 29 days since I prepared this slide. And there had been no price adjustments. The list price is where it was at the original day it was listed. The listing was kind of interesting. It said the property is, by acquiring this property, you're maintaining the original charm since 1963, and it'll provide you an exciting opportunity for personalization and modern updates. Well, I got a chuckle out of that. Those are kind of nice words to basically give you the clue that this home is pretty much all original. Some of the photos, there's actually still wood paneling in some of the rooms and that sort of thing. So for those buyers who are interested in maybe getting a good deal on a house and they're prepared do those modern sort of upgrades and improvements and kind of current design ideas, this property is obviously a good candidate because it is pretty original. And this would be the kind of property, given that it's original, that it's going to need some updating. This is the kind of property, almost a month on the market. It's not gone into escrow. There's no adjustment in the list price, where somebody will look at this and let's say they got 25% down. And maybe they're in a move up situation. They were in a condo for a few years. That was their first home. It's a big increase in equity. They've sold it. They've got some decent amount of proceeds. So they look at this place in Placentia and they say, okay, we're going to make a low price offer. We're going to offer $949, and we're going to be able to put 25% down because we sold our previous home. Well, that's a $50,000 concession. And with 25% down, the loan amount is going to be $711,750. Well, just keep note of this. If they did get a low price offer, 50,000 below, approved, accepted, with a 25% down payment, with that loan amount at current mortgage rate 0.675, their principal and interest is $46.16. Now that is $244 a month less than what the payment would be if they offered full price $999 and put 25% down. So the $244 a month does demonstrate some benefit to the borrower in lower monthly payment by that low price offer. But as I always say, that is probably one of the least effective ways to maximize your monthly payment benefit from getting that $50,000 concession. So here's the alternative idea. Again, a 3-2-1 temporary buy down. In this case, my suggestion would be to a buyer who's contemplating offering $50,000 below at $949. I say, don't do that. Offer $984 and then request a $35,000 seller credit. That would be sufficient to cover the cost for a 3-2-1 buy down, plus a little bit money left over for closing costs. At a $984 offer price, the loan amount's going to be higher, not $711. It's going to be $738 with that 25% down. But note, the amount of concession you would be requesting is still $50,000 from the list price. That concession amount of $50,000 is split up between the $984 offer price and then the $35,000 credit that's going to be used to support or fund the buy down. So the first thing to note is under this alternative, at the $738 loan amount, the note rate payment at 6 3/4, $47.87 for principal and interest. However, because now you've gotten that $35,000 credit to fund the 3-2-1 buy down, the first year rate is going to be 3 3/4, 3% below. The principal and interest is only $34.18. That's $1,369 a month lower than what the payment will be at the note rate in the start of 4. Second year, 4 3/4, $38.50 a month, $937 a month lower. Third year, 5 3/4, $4,307 a month, $480 a month lower than the note rate payment at the start of year 4. So what that means is over 3 years, the first 3 years of the buy down period, a borrower will save $33,000 in payments over that 3 years versus the market rate payment that they'll hit in year 4. And as I keep saying, that 3-year buy down period gives you that window where you've already owned the home, you've married the home. But remember, by getting this financing package to buy the home, you're dating the rate. And within that 3-year period, you have that ability to basically break up with that rate and refinance into a lower note rate when general market rates fall, as is still being predicted over the next couple, 2 or 3 years. So again, this is a much more effective way to optimize the financing terms to a buyer versus just offering below a list price and getting a market rate. So frankly, if anybody's in the Orange County market interested in buying a home in Placentia, contact me. I'll tell you give you the listing information. Be happy to put some numbers together for you directly. But again, this is a great way to get a home that's been on the market for 30 days plus and hasn't been sold yet. A great way to go after it, but with an offer that's going to provide much superior terms financially to that borrower than just taking and getting a lower price offer accepted. So hopefully that helps illustrate this strategy even more. We're going to keep doing this. I'm very passionate about temporary buy downs. They're underutilized in the market, and I'm going to keep doing this to let you know just how powerful these numbers can be and when you're trying to buy a home in this particular environment. So with that, I want to go to a whole different subject, and it's something that comes up actually quite often. And I have lots of conversations with new applicants when they're getting a loan and talking about, what they want to do in terms of the loan that they're getting. And in particular, there's a particular area that always comes up for conversation, and that is an impound account. So of course, on this segment, what I'm saying is I've got a question to impound or not to impound. So what the heck does that mean? Well, first of all, what is an impound account? I think if you own a home, you probably already know, but it can still be a pretty confusing topic. What an impound account is, most simply, is it's simply an account that holds your funds to pay real estate expenses, most often property taxes and hazard insurance or homeowners insurance. And now in some parts of the country, and even with lenders that you might have, that if you're a homeowner here in California, when you get your monthly payment statement, it's going to have a breakdown, principal, interest, and then usually it'll have a line item that says escrow. Well, what the heck is escrow? Well, escrow account is the same as an impound account. And of course, in California, escrow account can be confusing for us because here, unlike most other parts of the country, we have independent escrow companies that handle real estate purchase transactions. Back east, they don't have escrow companies. They use title companies and title attorneys. So that's the one thing to know from a verbiage standpoint. Impound account, escrow account, it's the same thing. The basic idea is what you're going to do if you set up an impound account. It is going to increase the cash you need at closing. And it also is going to mean that the payment that you're going to make to the lender every month is going to be higher with an impound account than without an impound account. Well, why is that? Well, the reason an impound account is set up is so that when you're making your monthly payment, it will include 1/12 of your property taxes, 1/12 of your homeowner's insurance. And then when the lender receives your payment, they're going to pull out of that payment that 1/12 of taxes, 1/12 of insurance, and they're going to put it in the impound account for each type of expense. They often call it a bucket, the property tax bucket and the hazard insurance bucket. So that gets pulled out of your payment every month. 1/12 of your annual taxes, 1/12 of your annual insurance premium goes into the impound account buckets for each. And then as that money accumulates every month when you make your payment, when the next installment is due for either taxes or your insurance, the lender disperses the payment for you so you don't have to yourself. And again, that's why I say the monthly payment's going to be higher if you do an impound account. But again, the offsetting benefit is when those taxes come due, which in California is twice a year, it's 6 months at a time, a big number. You don't have to deal with that. It's already covered in your monthly payment. So you're paying a little bit more per month, but then you avoid that big 6-month installment, which comes at bad times of the year, like right before Christmas on December 10 and right before tax time in the spring on April 10. So that's the benefit of an impound account. Now, if you don't have an impound account, the benefit is your payment to the lender is lower. It's only principal and interest. You don't have to include 1/12 taxes, 1/12 insurance. But then you have to have the ability to pay those tax and insurance installments when they come due. You have to have the ability to do that. Not all homeowners are comfortable with that, particularly on the property tax part, where you've got to come up with 6 months at a time if you don't have an impound account. So that's something important to understand. So which is better? It's personal preference. It's a matter of convenience. Some folks like an impound account. They think it's more convenient. They just want to make one payment, not have to worry about those tax bills and that insurance renewal when they come due. They figure it's already covered in their monthly payment. The lender will handle those disbursements when they happen. In some cases, it's not a matter of convenience for the homeowner. It's a matter of discipline. I've had homeowners tell me, I don't trust myself to not have an impound account and pay that 6-month installment for property taxes on December 10th. That's at Christmas time. I can't do that. I'd much rather avoid that. And that's why, since I don't trust myself to pay those installments on my own, I'd rather have an impound account. Now, one other thing about impound accounts, and I've actually done a segment on this before, and maybe I'll do it again soon. And I won't get into much detail on it, but when you do set up an impound account, watch out for the supplemental tax bill. That is a bill that's going to come out after you've acquired the home, and it's a supplemental bill because it reflects a reassessment of your property value based on your purchase price. And so that usually means there's an additional amount of taxes that are due from when you bought the home. And so that gets collected through a supplemental bill. Now, the one issue I want you to be very cognizant of is a supplemental tax bill, if you have an impound account, will not be paid by the lender. It is something you have to pay on your own when it comes to bills, comes due, I should say. So when you get that bill, don't just set it aside and assume, oh, I have an impound account, I don't need to worry about it. Not true. You don't want to do that. Make sure you make that, pay those supplemental bills yourself. Okay. Well, hopefully that helps you have a better understanding of the impound account and whether or not you should or shouldn't. Again, it really comes down to personal preference. And then now we'll go ahead and go into our closing question from last week. This is a pretty good one too. And again, I just had a conversation with a lady 2 days ago calling me about looking for considering a purchase of a manufactured home. And I had to go over this exact criteria. So here was the question that we had from last week. We're thinking of purchasing a manufactured home and have been told it's important that it has a 433A recorded. What is a 433A and why is it important? Well, first of all, let me kind of summarize what that document is. And it's a document kind of specific to California. It's a form that certifies the installation and permanent foundation of a manufactured home, allowing it to be legally considered real estate and potentially securing better financing terms. So what that means is a 433, when it's recorded, it is certifying that that manufactured home, that building, has now been fixed to the land. It's conjoined to the land, and that effectively is what makes it real estate. And that's what I have in the bullet point. Recorded legal notice that the home and land are now conjoined as real property. Now, why it will help you secure better financing terms is because all the typical conforming financing programs are available for manufactured homes with a 433A recorded. They also have to be built June 76 or sooner. But what it does by having a 433 on a manufactured home that creates or establishes that it's real property, then it allows us to originate many different loan programs, FHA, VA, USDA, conventional conforming loans. All of these program options we can fund or arrange and fund on manufactured homes if a 433A is recorded. So that's good. FHA loans only 3.5%, conventional 5%. So that is a benefit to have that 433A recorded. Now, what happens if the 433A has not been recorded? Well, then the property is not considered real property. It's not real estate. It's considered personal property. In fact, you pay your taxes through the DMV. And these kind of properties, they're typically not fixed to the land, although in some cases they have every appearance of being fixed to the land. I mean, there could be a foundation and they could be attached, and visual observation, you look at that and say, that's fixed to the land. Well, if a 433A hasn't been recorded, I don't care how fixed to the land it is, it's not real estate. And therefore, we can't make those kind of loans because it's not real estate. So it has to be fixed to the land, fixed to a foundation, and the 433A recorded. If not, it's considered personal property. You can still get a mortgage or you can still get financing. The term is a chattel mortgage. Chattel means personal property. So you can get financing for mobile homes without a 433A, but what you're going to find is the financing terms available are not going to be as attractive as all those conforming loan options that I mentioned earlier, where a 433A has been recorded. So you're going to be looking at most likely higher down payments and higher interest rates, in part because that mobile home, when it's not fixed to the land, it's a product, it's a building, it's an asset that is considered more risky. Why? Because it's going to be more prone to dropping in value in poor real estate markets. It's a asset that's not going to appreciate as much as a piece of real estate. And then the other issue is that the buyer profile for a manufactured home that's not fixed to the land because they're looking for lower priced properties usually is going to be, lower credit score levels, maybe more difficulty qualifying a debt ratio and so forth. So you can get financing on a mobile home, not fixed in the land without a 433A. The financing, though, is just not as attractive. So you're better off long-term, I think, although you're going to pay a little bit more. 433A recorded on a manufactured home means that value of the property is going to be a little bit higher, but I think in the long run, you're better off doing that. And you're going to see better, you're going to have a better experience in terms of future appreciation of the home, as well as getting better financing terms. So that's a good question. Keep that in mind if you're in the market for a manufactured home. And if you do find something with a 433A and want some numbers, give me a call. I'll be happy to put a worksheet together for you. And with that, I want to go ahead and finish with our closing question for next week. Here it is. Reverse mortgages, as you know, we do them. They're still very much misunderstood in a lot of situations, a lot of markets. And in this case, here's the question. For a reverse mortgage, isn't there a simple formula that can be used to estimate the maximum loan amount available, such as loan to value? That's a good question. If you ask me about an FHA loan, well, the max loan to value is 96.5. You can go with 3% down, 3.5% down. If you're a first-time home buyer, conforming loans, you can, loan to value is 97% if you're a first-time home buyer, 95 if you're not a first-time home buyer. Conforming conventional loan, if you want a cash out refi, you can go up to 80%. But what about a reverse mortgage? If you want one to refinance your home, can you go to 80% or 70% or 50%? What about on a purchase? Can you use a reverse mortgage and buy a home with a reverse mortgage where the amount of the reverse mortgage is 90% of the value? What's the formula? Good question. Not a straight answer. So I'll have that answer for you next week, and it'll be on the house. Jeff, back to you.
Sorry there, Art. We had a little technical difficulty there. I apologize. Great show. I have a question about that whole thing about the mobile home and the manufactured home. It is so easy, especially in the Coachella Valley, and I'm sure around many parts of the country, that, yeah, visually you're saying, hey, it's fixed to the land. It must be okay. But all manufactured homes are not 433 approved. Is that what I'm hearing?
That's correct. And it's something we run into from time to time because, like I said, it kind of reminds me of condos. Visual observation can be dangerous sometimes. And with manufactured homes, I've had inquiries where they'll say, I want to get a manufactured home, and I'll ask them all the questions about trying to establish, has it been fixed in the land? Is there 433A recorded? And sometimes I'll get answers along the lines of, well, yeah, it's definitely fixed in the land. I've been to the property. It's right there on the land. It's fixed. I've seen how it's attached and everything. Well, and then if I'll ask them about the 433A, they'll oftentimes either not know what it is, or they just don't know if that's been recorded. So I can easily contact one of our title company vendors, and I can easily look that up. And there's been more than one time where I've had that conversation and have my favorite title company pull up the records and come back and say, no, sorry, 433 has not been recorded. So I have to go back to that person who inquired and say, sorry, it has to be recorded. It's a California thing. If it's not recorded, it is not real estate. So I can't give you an FHA loan. I've got to get you I can refer you to somebody who does chattel mortgages. I won't be able to help you.
Is that something, Art, that you found that, is it a difficult process to have a 433A recorded, or, do you know anything about them?
No, well, it's really not. And in fact, the other thing I meant to point out on that segment that I just covered is that I've actually been involved in a few transactions where the property was fixed to the land, but the 433A was not recorded. But they managed to get a deal. Buyer seller agreed on a transaction where the agreement is subject to a 433A being recorded during escrow.
Oh,
so that can be done. Or in a case where It's a manufactured home. It's not fixed to the lot. But as part of the escrow period, buyer seller agree to the seller to go ahead and get the engineer, get it fixed to the land, and get the 433.8 recorded during the escrow period. So that can be done.
One other thing I want to ask you about is I want you to put on your cap and get out your crystal ball. Is what do you think the chances of this whole thing with the Freddie Mac proposal going through? I mean, let's face it, that is a tremendous windfall. But it feels to me like it's almost like we're kicking the can down the road. We're just doing it in a different fashion. We're not really addressing some problems. What are your thoughts on that?
Well, that's a good question. I mean, and I would share your concern. In fact, there's one. I think there's already one objection to the proposal. You know, and the objections founded on the idea that, well, is this really part of the Freddie Mac charter? In other words, is this really part of what Freddie Mac was created for? And you can make the same argument about Fannie Mae, because one of the things about this proposal is if it gets anywhere and if it gets regulatory approval, one thing I'll predict then is Fannie Mae will probably be not far behind, because both agencies tend to kind of go in unison with each other with a lot of these major new benefits and programs. So, so yeah, that there is a little bit of a, well, wait a minute, is that really what you were created for? I mean, your agency wasn't created to help people, borrow against their equity. Your agency was created to help, support and increase home ownership, and that's a different mission, if you will. So there's that concern. I think but on the other hand, I think I wouldn't be too concerned about, is this going to create some, programs that are going to end up being subject to higher risk and maybe more default risk. One of the things about the federal agencies, they're under so much regulatory scrutiny. I think to the extent that Freddie Mac gets involved, whatever the actual product that they end up offering, how it's designed is going to be in such a way that I think it'll probably be a pretty safe product.
With the prediction of it coming out as early as the summer and starting to expose that much available funding, I mean, is that realistic? I mean, here we are, we're at May 9th, and summer is not that far away. Is it realistic that it can go through the regulatory commissions and get it done that quickly?
No, I don't think so. And that's one part of that article that I saw that we just reviewed that I would find fault in, is I think that those are some rosy scenarios, as they say. I mean, those are a couple of big numbers. $1 trillion by summer, $2 trillion by fall. Well, guess what? Summer is what, 5 weeks away. It's June 21st. Isn't that the start of summer?
Yeah.
The government, in terms of the regulatory process for approval, and then Freddie Mac doing actually implementation, that ain't going to happen in the next 5 weeks. Yeah, I think those numbers are a little bit lofty. I mean, again, it's a good idea. I'd like to see it happen, but I think it's going to take longer than that to inject that many dollars into the economy.
Well, it's nice to see somebody out there is thinking of other alternatives. It's like there's got to be a better path, and this may be one of those ideas. So I really appreciate that, and bringing it to our attention. It's been great stuff. Hey, for those of you that have more interest and you say, hey, I have a reverse mortgage, I would like to get a reverse mortgage or a home equity line of credit, as Art says, those are really beginning to gather steam, as we have $32 trillion in home equity locked up in our homes. And, sometimes we have to get into that piggy bank, and he can help you do that through a home equity or HELoan. My name is Jeff Harrison. Art's information is on the screen. You can get a hold of him at 760-883-5700. That's his office number. And of course, you can always get him on his bat phone at his cell phone at 714-612-9035. He is always there and available to help you. He makes loans anywhere in Southern California. He can make his home in Orange County and also here in the Coachella Valley. So make sure to reach out to him. Art, as always, you can get a hold of him at art@mwloan.com. Please go to the website. There's a lot of information there. You saw earlier that it has the rate grid on there, but there's also a lot of tools on there that you can kind of do some of your homework and investigating before you get a hold of Art and say, hey, I'm ready to move forward. Can you help me? Art, thank you so much. I really appreciate all that you do. Another great show, and we'll see you next week.
Okay. Thanks, Jeff. Thank you, everyone. Thank you for watching and listening to this week's Mortgage Minute. Hang in there. Rates are doing okay. We're in the sixes, so no need to panic. If we can help you in any way to buy your first home or a move-up home and use some of the strategies that I talk about, in particular the temporary buy-down, don't hesitate to contact me. Be happy to have that discussion and give you some tangible numbers. So until next week, I'm Art Alvarez at Mortgage Works, where we have the answers and they're on the house. So long. Take care.